Okay, guys, so in this video, I'm going to be showing you what a covered call is and why I really like covered calls and how you can generate a little bit of extra income on your portfolio for the stocks you already own using what I consider to be a very low risk strategy and in a really low risk way to do that, to just get a little bit of extra income from your stocks. So, first of all, what is a covered call? And if you remember, by the way, I'm also kind of assuming that you already have some knowledge of what a call is. It's okay if you don't, but that would kind of be ideal. So if not, go ahead and check out my last video. I did a video on, the basics, like what is a call option 101. So go check that out. I'll leave a link down in the description below. But first of all, what is a covered call? So if you remember from that previous video, a call option, when you write a call option, you're selling somebody else the option to buy that. In this case, we're talking about a stock. So you're selling somebody else the option to buy a stock from you at a certain defined price called the strike price. So when you do it covered, what happens is that you actually already own the stock. You would do it with stocks that you already own, and you actually have to own 100 shares. And the reason being is because option contracts are traded in lots of 100 shares. So one option contract is the right to buy or sell 100 shares of a stock. So hopefully that makes sense. Anytime you see one option contract, think 100 shares. If you see two option contracts, think 200 shares, and so on and so forth. So what I do with covered calls is for the stocks that I own 100 or more shares of, I'll write a covered call. So again, I'm selling somebody else the ability to buy those 100 shares away from me at a certain price. And I'm usually writing it above the market price. The strike price is actually above the price that the stocks are currently trading at. And I have AT&T. I'll show you. This is one of the stocks that I do this strategy with. So right now, AT&T is trading at $28 and some change, almost $29. So I own 100 shares of AT&T. And so sometimes what I'll do is I'll write a call option for, let's say, $29.50. So again, what that does is it gives somebody else the ability to buy AT&T away from me at $29.50. Now, you may have already realized this, but one of the major drawbacks to this strategy is that if the price of the stock goes up, let's say AT&T goes crazy, they have some really good earnings report or they have some really good news, and let's say the stock goes all the way up to 34, which it has before. You can see it almost got there here. If it goes all the way up to 34, well, now I'm out of luck because I had to sell it at 29.50, and that's kind of a bummer. Even though I did get to collect some premium from the option that I wrote, maybe I got paid $10 a contract, which sounds great, or it's not really much money, but I could have made so much more money if I had just held on to my shares and rode the stock up to 32 or whatever, wherever it got to. So that's why it's really important, and I want to make sure I say this very clear so you guys understand. You do not want to write covered calls on stocks that you are bullish on stocks that you think are going to go up higher. Let's say you're really bullish on Tesla and you think Tesla's going to go way up because Elon Musk is just so great and he does all this great stuff. You wouldn't write a covered call on Tesla because you would just own the shares and you would ride that wave of price appreciation and just cash in whenever you want to cash in. So again, that's really important to just note. The other downside of writing a covered call is that you do own the shares. So you own 100 shares. And so there's always the risk that the stock goes down in price. So what if, let's say, AT&T had a really bad quarter and the stock goes down to $27.50? Well, the good news is that you still get to collect that premium from the option. So you still get to collect, in this case, let's call it $10, but you lost money on the stock going down. So it's not really great. And here's really the kicker. Here's the take home message and the main point. You want to write covered calls on stocks that you're bullish on long term, but in the short term, you think that they'll stay either at the same price that they are now or maybe they'll even go down a little bit and you're okay with that. And you go ahead and you write that covered call. So for instance, I do it on AT&T because if you actually look, AT&T really kind of trades in this range, and it doesn't really, it doesn't, it doesn't have a ton of volatility. So it's not like going up to 37 and then down to 25. It's mostly staying within this range of like 32 to 28. And so what I do is I write covered calls, on AT&T, and what I'm doing is I'm collecting a little bit of extra income for writing these covered calls, and I'm also getting, AT&T pays a fairly nice dividend, although it just got cut. They pay, I think now it's going to be like a 3% dividend. So I'm getting the dividend and I'm getting the premiums, collecting the premiums from the covered call. Okay, so hopefully that's clear. I like it with AT&T. One thing though to keep in mind though is because AT&T trades within this range and there's not a ton of volatility, it also means that the premiums on the calls are not going to be that high, and that hopefully that's kind of that's sort of the trade-off, right? If you're writing cover calls on Tesla, because there's a ton of volatility on Tesla, the premiums are going to be high, but there's also that risk that it goes up higher, and then you kind of I'm hesitant to say lose money, because here's the thing that's really interesting about covered calls is that if you were going to own the stock anyway, there's kind of like no way that you can really lose money with covered calls. I mean, of course, you can lose money on the stock going down, but you're not going to really lose money on writing a covered call. Now, you may lose out on the potential. You could have made more money had you just held the shares and not written the covered call, but you're not going to lose money by writing the covered call. So that's why I really like it. It's really low risk. And so it works good. Another stock that I like it on is called Realty Income. They pay a little bit more of a dividend than AT&T, and the options premiums are a little bit higher too. So it's kind of a double whammy. You can do it with dividend stocks, and those are my favorite to do it with. And let's say, for instance, AT&T, let's say I wrote that covered call for $29.50, and let's say AT&T did go up to $29.50, or even let's say it went to $30. I'm okay with selling AT&T at $29.50, because what I might do is I might just buy it back at I might wait till it drops down a little bit more and then buy it back and write another covered call and just kind of rinse and repeat and do that over and over again. So anyway, I don't want to make this video too long and drag it out, but basically the take home message here is that covered calls are a great way to get a little bit of extra income, on your stock, with very, very little risk, very little risk. And so that's why I like it. And in the next videos, I'm going to be showing you how I do it in my brokerage account. So you can look, basically look over my shoulder and see exactly how I'm writing these covered calls. And, you can see the amounts of premiums that I'm collecting, et cetera, et cetera. So anyway, hopefully this makes sense to you guys. Maybe I'll do a whiteboard here too, and actually draw it out. Actually, let me try to do that now. So see if this works. So let's say this is how it would look, right? I would sell AT&T call at, I said $29.50. Okay, so, and then I'm going to say, let's say the expiration, what's today? Today is the 27th, but it's a Sunday, so the market's not open. So, and here's another thing to keep in mind. So options are usually either weekly or monthly. So, and they expire on Friday. So I'm going to sell, in this case, let's say, I'm not sure if, I don't have my calendar pulled up, but let's say August 6th is a Friday. Let's just say that, right? So I'm going to sell the August 6th AT&T covered call at $29.50. Okay. And right now it's currently trading at $28.89. So there's a couple different scenarios of how this could go. Let's say AT&T goes up to, let's say it goes up to 30, right? So now what ends up happening is I have to sell these, my 100 shares. Again, I own 100 shares. I have to sell them at $29.50. So, it's not the end of the world. I guess I lost out on 50 cents times 100 shares. That's what, like $5. So it kind of ends up evening out. Really, if AT&T goes up to like 35, that's when I'm kind of like, it wouldn't have been a good move, because I could have just ridden it all the way to 35 and then I would have made an extra like $5.50 per share, which times 100 is like 550. So basically, let's say so from this, oops, where'd I go? Okay. So by writing this call right here, I collect, we'll call it $10 in premium. Okay, not bad. I mean, it'll pay for a Chipotle meal, barely, but it's not nothing either. So that's what that is. And then if what I want to do here is I want AT&T, on August 6th, anytime between now and August 6th, I want AT&T to stay the same or go down slightly. Okay, I don't want it to go down a ton because, again, I do own the shares. I do own 100 shares, so I don't want it to tank, but I do want it to stay either the same or go down. Okay, you get go down. And what would happen then if it stays the same or goes down, the contract that I wrote would expire, what's called expire worthless. Oops. And I would collect the $10 premium